So before I start these numericals, first let's understand how the loan works. Now, when I say from the professional exam perspective, whether it is CFP or CFA or CWM, by default, the loan computation is based on the reducing balance method or known as amortization. Okay. Otherwise, when we go for a small loan or the two-wheeler loan and other personal loan, then many times I'm not saying you know 100%, but many times, most of the time, it is based on not the amortization but on a flat rate basis. Okay, so here I will discuss about the reducing balance method. Okay, so how it works. Now, as the name say, amortization. Okay, now if I say simply, like, we have depreciation for tangible assets. So suppose the furniture, machinery, equipments, plant, all those fixed assets, or we call it long-lived assets. They, when we use, its value get reduced. We call it depreciation. Same way for intangibles, for example, loan. They are also depreciated, but the correct word is amortize, and the process is known as amortization. Okay, so same like depreciation, if you are from the commerce background, same like depreciation, how the asset value get reduced because of its usage. Same way, when somebody takes or borrow, okay, and he start paying, the borrower start paying the principal as well as interest, its amount get reduced, the principal get reduced, or we call it, it is amortized. Okay, so that's why reducing balance or amortization. Okay, another thing is when we, I mean, if you have taken a loan, then you, your tax consultant, or suppose if you are, working as a financial advisor, you always ask for the statement, okay, that provide the, loan statement. So if you see the headings of loan statement, you will find the headings like the month. Okay, what the month is, let's say, suppose if the month is March, so we start from March. Okay, March 21, then April 21, and so on. So we have the month, then what the principal, what is the borrowed amount. Okay, so I'll just put principal in the beginning of the month. Okay, so principal in beginning. Okay, after that, we pay the installment, okay, known as, if it is monthly, then we call it equated monthly installment or EMI. So we pay the EMI. Now this EMI have two components. The EMI have the principal as well as the interest component. Okay, now interest is income for the lender and it is cost to the borrower. So we have interest amount, and plus we have the principal amount, or we call it principal repaid. So what we have done, this EMI we bifurcated, we divided into interest and principal. And lastly, we have principal at the end of the month. So principal at end. End means end of the first month. Okay, so suppose if I say today is 1st March, let's say I'll say March 21. Okay, and let's say loan is taken for instance, I'll go with a small amount, let's say 100,000. And of course it is, since the person is paying the interest, so there is a rate of interest. Okay, so I'll put the interest is, again, for simplicity, I'm taking 12%. Okay, the logic I will tell why I've taken 12% for the explanation part. So I've taken 12%. Now remember one thing, since it is monthly and this is per annum, by default, okay, I'm saying by default, then it means if nothing is specified, then what you have to assume that this 12% per annum is compounding monthly. So we always divide by 12. Okay, so I'll see, from the exam perspective, especially I'm talking about from the CFP and CWM perspective. In the CFA, they always clarify the thing. But in these two exams, what I have seen that if it is 12% per annum, that it means it is compounding on a monthly basis, compounding monthly. Even if it is not written, okay, even they have not mentioned, still you have to go that it is compounding monthly. So it is per annum compounding monthly. So if it is compounding monthly, and if you are using Excel, then what you have to do is this 12% you divide by 12 months and you will get 1%. Okay. Now equivalent calculator function I will tell you shortly. But the thing is, this 12% you have to divide by 12 months. Okay. So we have to calculate the EMI now. So how to calculate? We'll see both mathematical function as well as the Excel and calculator function for it. So there is a principal of 100,000, 1 lakh, and on that, on a monthly basis, 1% is the interest. Okay. Now the thing is, what is EMI? So as I said, we have a formula and we have uh, the inbuilt function of Excel as well as the financial calculator. So I'll put Excel or financial calculator, like for example Casio FC 200V, or if you are using Texas Instrument, in that also you will find PMT function. Okay, so first what I will do is I will go with the inbuilt function, what the inbuilt function is. And it's very simple. It is a short form known as PMT. PMT stand for periodical payment. So if you see EMI, it is periodical payment. Okay, means if what is the period? The period is the months. So every month this borrower have to pay. Okay, so if you are aware of the Excel, simple, you start with equal to, write PMT. Okay, and you can see the syntax, you can see the arguments here, the parameters. The first you can see here is the rate function. Okay, what the rate is. Okay, and what I assume is, let's say 12% or 1% per month. Okay, so what I'll do is, and same thing you will find on the calculator also. So what I'll do is, I'll put here rate means interest. Okay, then you will find n per, simple, number of period. On the calculator you will find the letter n. Okay, but on the spreadsheet, whether it is MS Excel or Open Office, Apache Open Office, which mostly you will find on the NSE Center. So if it is if you are using the spreadsheet, then you will find n per, which is number of period. Okay, then you will find PV equal to present value. Okay, FV equal to future value. Okay, and then you will find type, whether it is the mode is end or beginning. So I'll explain all the things. And of course, the PMT is the periodical payment. So I'll put here PMT is your periodical payments or cash flow. I'll put simple CF, cash flows. So it can be receivable or it can be payable, simple. So with this abbreviations, okay, I'll use the function, inbuilt function. So I'll go with the PMT, and the rate is 1%. Okay, and we have to follow the sentence. N per. Now, what is N per? N per is the number of period. Now, let's say again for simplicity, what I'm doing is I'll take for let's say 2 years. So somewhere here I will mention it. Okay, but I'm just giving the cell reference here. For me, it is C6. Okay. Now, what is the PV? Present value. At present, what the amount is, which is 1 lakh. Okay, so somewhere here I will mention the principal and the future value. I mean, there is no future value here. Okay, future value means, as the name says, future means in future. So there is no value, zero. And the most important thing, okay, the type means when the EMI have to be paid. Okay. Now always remember, suppose if I take a loan on first Feb, then of course at the end of the month, that is 28 Feb. So end is 28 Feb, or end of 28 Feb is the first month. So definitely I will pay at the end. So you can see here, end of the period is 0 and beginning of the period is 1. So when it comes to the loan, we never pay EMI in the beginning. It is always when I take the loan today, then of course at the end of the period or at the end of the day, we have to pay the EMI. So by default, always remember you have to take 0. Now, if you are using calculator, you have to make it sure that it is end. Okay, in the Casio or in the Texas instrument, it have to be end. So you have to set it. The mode have to be end. The set have to be end. And I'll enter. So let me first write the loan amount. It is 1 lakh, and here the number of period is 2, or since it is monthly, so 2 multiplied with 12 months. Okay, and of course I'm getting negative. Nothing wrong with it. Okay, why I'm getting negative? Because this is the EMI we have to pay. Now since it is negative, but I want to see positive value, we also know that it have to be paid. So there are two ways of doing it. Okay, the simplest way, if it is Excel, then I'll put minus sign here. As a prefix, put minus sign. So minus minus is plus. So one way is doing like this. Okay, another is, if you're not using minus as a prefix, you can mention PV as minus. Now, only thing where the candidate get confused, what the candidate says that it is loan taken, it is inflow, then why we are taking negative? Okay, and the thing is pretty simple. Why we are taking negative? So that I can see positive. Okay, but that justification is not so rational. So, but in a calculator you have to use minus. You have to take minus 1 lakh or minus PV, so that you have the plus sign. Otherwise in Excel I always say use prefix minus, so that you can have a plus sign. So this is how we find the EMI. So again, I'll say PMT stand for the periodical payments. Okay. Now it have multiple use. Now in the loan case, we are finding the EMI. Okay. When it comes to the investment, we go with the SIP. Okay. Same way, rate is the interest rate. We divide it by 12 because by default it is compounding monthly. Okay, number of period 24 months. Present value is the principal. There is no future value, and the set or the mode or the type have to be end or beginning only. Sorry, it have to be end only and not beginning. Okay, so this what we have done using uh, the inbuilt function. There is a mathematical function also. Now the thing is why I'm introducing this thing, because let's say suppose if you are beginner, the thing is if you use the maths formula, then it becomes easy. Easy in the sense easy to understand other time value of money problems also. Okay, so 3 4 times you can practice with the maths formula. Once you get comfortable with it, then go for the inbuilt function. Okay, because the main thing is, what I have seen is the candidate feedback is that we are unable to crack, or we are unable to identify, recognize what function we have to use. So the good way is you can go with some basic mathematical functions. For example, if I say your FV, future value you have to find, then you have to use PV into 1 plus rate raised to number of period. I know we can do using the inbuilt function FV. Okay, but these are important. Same way, if you have to find the PV, the above formula can be restructured. Okay, so FV divided by 1 plus rate raised to n per. Now, all those basic things maybe I will take in next session. But if you are aware of these basics, if you have covered the fundamental, then I hope you have seen all those formula in your books. Only thing is, this is very important formula. If you remember this, you keep PV here only, and this factor you bring to the left hand side in the denominator. Okay, so the first formula is important. Now this what we have done is for the lump sum. Now when it is recurring, we call it annuity. Okay, then somewhat formula differ. So for example, if I say present value of annuity, okay, so it is your annuity multiply with the annuity factor. So which is your 1 minus 1 upon 1 plus rate is to n per, and the whole divided by again the rate. Okay, we can go with this formula also. Okay, now what I'm doing is, see what we have to find is the PMT. So if you see here, this is your PMT, right? Okay, and this annuity is recurring. Okay, as the name says, annuity, which is annual on a recurring basis. But the thing is, we are working on a monthly, so it can be monthly also. But the thing is, it is a constant amount for constant period. So actually, we have to find the PMT, this annuity. So again, we can restructure the formula. Now, what is the present value? It is 1 lakh, and this is the annuity factor. Okay, so this is the factor. What we can do is this we can bring to the left hand side in the denominator, and we can find the EMI. So let me go with it. Okay, so I'll directly put here. So it is your 1 lakh and divided by 1 minus 1 divided by 1 plus rate leads to 4 months, and again divided by rate. So if I enter, and we are getting the same. So 4707 and 4707. So the thing is, I'll tell you, I have seen extreme cases where even person from hospitality industry or somebody worked in a shipping, you know, in altogether a different sector, not finance sector, and they are able to complete all this. Especially, I'm talking if I say CFP program. The reason is, what the reason or what the how they have practiced is that they followed the same approach, means everything they have done using the mathematical formula. Once they are comfortable with it, then they start using the inbuilt function. So the thing is, what I assume that if a non-finance people with a, let's say hospitality experience of 15 years, 18 years, they are able to complete these programs, then anyone can do this, I know. Okay, so only thing is we must have the correct approach of approaching these professional exams. So this is how we found the PMT. Now the thing is, this PMT, or we call it the EMI, have two components. So if you see the formula here, the rate is there, okay, which is the interest rate. We have the principal amount, fine. So it is made up of two things, the principal as well as the interest amount, and that's why we bifurcated here. So if you see this EMI, I'll just give the reference here. So this EMI have the interest amount. Now the thing is, how much interest? Now again, what the logic says, that interest is always on the principal. So what we have to do is, this is the principal for March, okay, and simply we are multiplying with the interest, okay, which is 1% per month, and we have 1,000 rupees. And next what we have to do is, this EMI we reduce from the interest amount, okay, and what we will get is the principal. So this 4707, which is going to be constant for next 24 months. Okay, so I'll put here the time period. Let's say this is the first month, and in total I've taken 24 months. So I'll go up to 24. Okay, and this is March. Then I'll go with April. So we are at the first month. So 1 lakh EMI interest is always on the principal. Okay, when we take the difference between the EMI and the interest, what we get is the principal, uh, because we want to know like what the bifurcation is from the tax perspective. Interest, if it is a home loan, then interest can be shown under section 24. Okay, and if it is a business loan, then it can be shown as a debit or expense in the income statement or profit and loss statement. Now, what is the principal remaining? So, what is in the beginning less what is paid? Okay, so that way we get to know, or we did for the first month. Now, what happened in the second month? Let's say it is in April. So, the principal of the first month, that is March end, will be the beginning. Okay, always remember 31st March, the next day is 1st April. So, end, the closing will be the opening for the next month. Okay, now different books use different words. Some says loan in the beginning, loan at the end. Okay, so those things you can find. So next what we did is the end balance, the closing balance will be the opening for next month. Now remember EMI will be same only. Okay, now the Excel function again I'm using is the absolute function, which is F4, function key F4. Okay, we made it absolute so that it always take this value. Okay, now one thing is sure, there is no change in the rate. Okay, so this is going to be same only. So I'll complete this. Okay, another thing is we have to be careful that interest is always on the principal. Okay, so for the next month, the interest will be on the principal, which is 96,292. Fine. So this interest, which is 1%, will be on this. So this one, we always need the 1%. Again, I will freeze it using the F4 function key F4, and you have a dollar sign. Okay, so that way you will always see that the principal in the beginning is always multiplied with the 1%. Okay, so I just press the F4 function key to have a dollar sign, and then I will complete this also. Okay, now the thing is, okay, so just a minute. F4, F4. No, it is fine. And I'll double click, and you see the formula. What the formula is, that principal in the beginning, and we are multiplying with the 1%. Okay, the formula is set. Very simple. The formula is set. Okay, and this formula is already set only, which is your EMI less the interest amount, and this is also set. Now the thing is, when all the formula are set, we just have to double click on this, and we have the amortization table. Okay, so some mistake I think. Yeah, so this also I have to freeze it. Okay, so I'll freeze this. So I'll repeat again. And okay, let me show the end result, and what you will see that why it is called amortization, because it is reducing. We are writing off. So what the loan amount is in the beginning, it is 1 lakh, and if you see the closing balance, the end balance, it is 96, 92, 88, and at the end of 24th month, it will be zero. So you can see the last line, it is zero. Means loan is finished, loan is closed. Okay. Okay, so fine. So I hope it is fine with you. Now, any question with this, let me know. Do you have any question on this? Or if you have, yeah. Mm-hmm. Exactly. Mm-hmm. Correct. Mm-hmm. Mm-hmm. Correct. Now the thing is, suppose now there are two, three possibilities. Somebody took a loan on, let's say, 15 Feb. Okay. But the bank will say the EMI will start from 1st of March. That is also possible. Or the bank will say you have taken on 15 Feb, then it will the EMI will be on every 15th of the month. That is 15th March, 15th April. The thing is very simple. The day the loan is disbursed, the loan interest will start accruing. It's very simple. So suppose if it is for 15 days, then bank will divide interest for 15 days. Okay, and that's why what I have seen many of the bank, including the SBI, they don't do monthly compounding, but in fact daily compounding. So it becomes simple then. So they start charging. So what we have done here is we divide it by 12 months. So it can be, if it is a daily basis, then we will divide by 365. Okay, and daily interest is calculated then. But of course, it have to be cumulated and paid on a monthly basis. Is it fine, sir? Yes, but cumulatively, we have to pay on a monthly basis. So I saw this with the SBI. It can be with other public sector bank also, but with the private sector like HDFC, I've seen on a monthly basis. From the exam perspective, it is monthly basis. Yes, Anirudh. हाँ, so suppose अगर EMI नहीं दिया है, then there is penalty actually. पेनल्टी और वो ऐड हो जाएगा नेक्स्ट ईएमआई में. एग्जैक्टली. Okay. So the thing here is, this is how it works. Uh, now, when now the thing is, what type of questions in the exam can be asked? Okay. In the exam, they can ask like, what is the interest in the first year? Okay. Now, of course, what we did is we prepared the amortization schedule. But in exam, there is a time constraint. Okay, we cannot prepare. I mean, of course, if we are really fast, then we can go with the amortization schedule. But there are shortcuts, there are short ways, there are different keys on the calculator as well. There are inbuilt functions in the Excel where we can even use those keys or functions to find the answer. So the thing is, first thing is the question can be like how much interest one can claim in the first year or second year. Okay, what is the principal now? Now let's say suppose if it is a home loan, then the principal on home loan can be shown under section 80C. Okay, of course the limit is 1,50,000, but it can be shown. So what is the principal? What is the outstanding balance? Now here the thing is, this is pretty simple. Means the rate is not changing, but all we have to remember that rate is always floating in nature. Okay, so if rate change after 10 months, if rate change after 2 years or 36 months or 60 months, then what? And of course the rate changes. We get a notice that from next month or the next EMI will be on this particular rate. So those, I mean, with those things, the complexity increase. And again, like you said, if somebody default, then what about that? Okay, so again, the cumulative effect it will have, because the bank will never compromise on the interest. Okay, because this is on which the condition it is granted, that you will pay on time and you can use, this is what the mortgage is, you can use the asset. So next part is, if you see, I have some question with me, means with this basic. Okay, the first question, if you see, and this is again practically it happens in the market. If you see the first question, okay, people, like suppose if I go to the bank and borrow the amount, at the same time there will be another executive or the person representing the investment department or desk. What they will say that, sir, you have taken a loan simultaneously, why don't you start the investment also? Okay, and let's say if you are earning some rate of interest, you will be in position to close the loan. So two things happen. From the bank side, bank have lended, bank becomes the lender, at the same time bank have, bank have given a solution also. Okay, if I tell very positively and in a very good manner, then bank have given solution. Okay, if I talk from the sales perspective, bank have sold the loan, at the same time bank have sold some portfolio and or mutual fund also. Okay, so if you see here, now with this question I will tell you how to do on Excel as well as on the calculator. If it is a calculator, then we have to do some trials. If it is Excel, then we can find exactly. Okay, so how we can go about this? But what I'm seeing, this thing I've seen for a long time, sir. In the sense, correct, correct. So exactly, exactly. So sometimes, but see, the thing is, it is we have 20 years with us. So in 20 years, 13, 14, 15% returns, at least the index, from the index we have seen historical if we see. So there are so many, sir, possibilities are there, but on a positive side is that at least person is saving. So actually I appreciate this approach, because what generally household sector do is they take maximum loan beyond their capacity actually. So that is more like a trap for them, means they get stuck. The thing is, we should always have, and that's why we have all this the budgeting and cash flow management. So we should not go with maximum loan, we should always have the intention to save, and then we should go for the debt. But the world works, mostly the majority works in the other way, they go with the loan first, and they do anything, you know to take the loan. They even don't evaluate how much interest they will pay, and those are the troubles actually, and that's why bank nifty is very favorite for everyone. So, so I'll go with it. Okay, so I'll take the first question of today, and I'll take a new sheet. Okay, and this we will see both on Excel as well as calculator. Okay, so I'll start with what the loan amount is. 35 lakhs. Okay. The rate is 8.75 and the time period is 20 years. This is per annum. And again, remember it is compounding monthly. This is 20 years. And what he is doing is simultaneously he is investing 50,000. Okay, and he's expecting 15% per annum on a monthly compounding basis. And he wants to close the loan. So he's saving also and he's paying EMI also. What the question is asking that how soon? Now it is a strategy. It is a good strategy actually. So if he's saving, then his saving will be more than the principal, or his saving will be more than the borrowed amount. Then how soon he is able to close the loan? So if you see, this is a 20-year loan. So 20 into 12 is 240. It is 240 months loan. But since he is saving also, then if you see the option A, B, C, D, then definitely he is going to close the loan. Means his savings will be more than the borrowed amount. Or what we have seen just now, that his savings will be more than the closing or the end balance. Okay, so here I'll go with the solution. Okay, another thing is savings I put here. Savings is 50,000 per month, and what the returns he's getting is 15%. 15% monthly compounding. So first thing, by default, it is compounding monthly, and if it is so, then we always divide by 12. Okay, and same here also, this 15%, we always, I mean, we have to divide by 12. Okay, we'll divide by 12. Okay, now next thing is this 20 years will multiply with 12 months, so we have 240 months. Now, if it is a Excel approach, okay, first go with the Excel approach and then the calculator. Now, on the calculator, you will find all this set and your end will be 20 into 12, okay, where you will get 240. Your I percent is 8.75. PB is your loan amount, which is minus 35 lakhs. PMT you have to find. Then FV is 0 slash Y. Since it is monthly, I'll go with 12, and compounding by default, as I said, it will be monthly compounding, so 12. And what you will get is your EMI. So on the calculator, first thing is you have to find the EMI. Same way on the Excel also, the first thing is I'll go with the EMI, which is nothing but a PMT function. Okay, so we'll go with the PMT, your monthly rate, 240. PB is, I'll go with minus this, and 0, 0. So check whether you are getting this or not. So on the calculator, you will get same. Okay, that is 30,929. 30,929. If you are not getting same, please let me know. Or if you are not getting, then also let me know. Sorry? No, and loan is always end. Okay, uh, so always remember. I'll put a note here. Okay, I'll put a note here on this sheet. I will mail you. note is EMI is always at end, that is type and or zero always. Okay, and interest rate is by default by default compounding monthly. If it says something else, then you have to go with that. Suppose if they say yearly compounding, then you go with that. But in the absence of any information, if the question is silent, then you have to take compounding monthly only. Okay, and we always have to pay EMI at the end. So type or the mode will always be end only, sir. I'll go with the first solution one. So what we have is the EMI. Okay, next is I'll go first with the Excel approach, and we need the month, okay, loan in beginning, or you can say this is your opening balance. Okay, then you have the EMI, you have the interest amount, and then for the principal or loan repaid and loan at end. That is the closing balance. Closing balance for that month. Okay. So see, as I said, when we are doing on the calculator, then we have to go with the options. Okay. Means options means 94, 47, 23, 108. Fine. So we have to at least do three trials. In Excel, I will go in a very straight way. Okay. So first thing is this is for 240 months. But if you see the option, the maximum value is 108. So I'll go with 108, or even if I take 240, I will take hardly 5 seconds more to do it. Okay, what the loan in the beginning is 35 lakhs. Okay, what the EMI is 3929. Okay, and I will freeze it because we always need 3929. What the interest is always on the opening balance. So this opening balance multiply with the rate. We always need this rate. I will freeze using F4. What the principal repaid is your EMI less the interest amount, and loan at the end is 35 lakhs minus what the principal repaid. Okay, and the next month, the loan at the end will be the opening. The loan at the end of the first month will be the opening for the second month. Once it is set, okay, we just have to double click on this auto fill handle, and that way we have the whole loan schedule of 20 years, and you can see it is zero. Suppose if you are doing on Excel and you are not getting zero, let's say, okay, you take the number, okay, format it, you go with a number, and you will have a zero. Okay, now next 50,000 per month. Okay, and we have to see in which month the savings will be equal to or more than the loan amount. It's all say savings. And yeah, please. Hmm. Table is simple. If I uh-huh. Okay. So the thing is, see, you are here, right? You have done till here, right? Correct. Now you can see this dot. This is known as fill handle. You can see this dot, right? If you so if you you can see a square dot. Okay, so this dot, correct. So on this dot, you have to take your cursor. Okay, you will see a plus sign and double click. Now no need to worry about what values you are getting. Okay, because see it is zero because it is linked to the previous year. Sorry, previous month. It's linked to the previous period, right? So no need to worry about you are getting zero. More important is you fill the table. Now this 30,000 it is for every month, so you should get 30,929. Okay, because see you have to freeze it, right? You have to freeze it. You have to put a dollar sign if you are doing, है ना? So if you put a dollar sign, then for next 240 months you will get the same value. Same way for the interest. Okay, the beginning will be relative, means it will move relatively, but we always need the same rate of interest. It is not changing. So that have to be absolute, means press F4 and you will get a dollar sign. And then again on this dot, double click. Don't worry about the zeros. Your formula should be correct. Okay, and like that you complete it. All the values will change, and at the end of 240th month you will get zero. Fine. Okay, now so if you done, and next thing you just I mean those who are new here, what you do is you you mail me on this. I will share the recording as well as the Excel sheet. So you mail me, just put a test mail to me or ping me at my number. Okay, so I will mail the recording as well as all this Excel sheet. Okay, now next is I'll go with the savings. Okay, now saving, if you see, it is 50,000. So if it is 50,000, okay, then understand one thing. Okay, what I am assuming that his saving is in the beginning. Okay, so what I'll do is I'll put your savings in beginning. Okay, so you know very well that in certain instrument like PPF, or even if it is a mutual fund where the daily NAV is calculated, so compounding is on a daily basis. Similarly, in the PPF, if you deposit the money before fifth, that is first, second, third, fourth, then you get interest for that month also. So here I'm assuming that savings are in the beginning. Okay, if it is in the beginning, okay, what I'm using a formula which I have just I think here I have written, okay, which is FV equal to PV into 1 plus R raised to number of period. So see what I'm doing is this 50,000 is earning 1.25. This is first month. 50,000 is earning 1 plus 25. Okay, in the beginning. So what I'm getting is 50,000. Now very important thing, understand this process. The previous balance, and again he will put 50,000. Okay, and it will earn 1.25. Because why? Because this is savings are 50,000 per month. Every month this investor is putting 50,000. So we have to take previous plus again 50,000. Okay, So I'll repeat, 50,000 is the first month investment and it will earn 1 plus 1.25%. Second month, we have to take previous value because it is not withdrawn. And this is what the compounding is. So we have to take the first month and again the person will deposit 50,000 and combining, I mean, both the values, combined values will earn the monthly interest of 1.25. So that way, the cycle will continue. And I'll use autofill. Okay, this fill handle. I'll go down like this, and what I can see is again the previous value plus 50,000. And okay, I have not freeze it, so I'll freeze that because we always need 1.25, right? So I'll go like this. Okay, and let me check the formula using F2. So previous value plus 50,000 and into 1 plus 1.25%. Okay, again I'll go down. I'm just testing it. Okay, it should be correct. So it works. Okay, now it is perfect. And what I'll do is I'll go like this. Maximum is what, 108 months in the option. So I'll go with 108. I'll go till 108. Okay, and you can see it is pretty high. The value is big, 1 crore 14 lakhs 42,009, sorry, 391. So you can see that this person, this borrower, an investor can definitely close the loan. Okay. So here the thing is, let me see what the option is. First option is 94 or starting with the lowest, let's say 23rd month. So what I'll do is I'll go to the 23rd month and you see the end balance, which is F column and 23rd month. So it is 33 lakhs and this is 13 lakhs. So 33 lakhs and 13 lakhs. So loan outstanding is 33 lakhs, whereas the savings is 13 lakhs. Okay. Next is 47 month. We'll go to the 47 month. Okay. And you see here again the F column and 47th month. Now here the loan outstanding is 31 lakhs, whereas the accumulated savings are 32 lakhs. So 31 lakhs, 31.98, let's say it is close to 32 lakhs. And here also the savings are 32 lakhs, 32 lakhs and 11,419. Of course, when you go for closure of loan, the bank can charge some processing fees and penalty and all those. So it means that by the 47th month, his savings are sufficient to close the loan. Very simple. Okay, and I will say it is a good approach. Okay, so I hope it is clear how we are going to do on the Excel. But suppose if you have never used the Excel and if you are using calculator, okay, then how we can do it? On the calculator, first thing always remember when it comes to the loan, you have to find the EMI. Okay, and I presume that you know how to calculate this. You somewhat you are familiar with the calculator. So first thing is you find the EMI. Now next thing is you have to go to the amount AMRT. Next is, so this you are doing on CMPD. Okay. Next thing, once you find the EMI, you press AMRT. Okay. And in the AMRT, you will find PM1, PM2. Okay. PM1, PM2. Okay. Or I have the calculator. I'll show you. I have both the calculator with me, Excel instrument as well as the Casio calculator. Okay, so first thing, I'll just show to you. So this is the Casio calculator if you are using this. Okay, so on the Casio calculator, you can see this. I think you can see here AMRT key. Okay, so CMPD and AMRT. Okay, so you go to the AMRT. First thing is you have to find the EMI. Okay, so what I'll do is I'll go to the calculator part. Okay, N is 240. This is 8.75. PB is 35 lakhs. Okay, you have to find the you have to find the PMT. Okay, and on the calculator, what I'm getting is 3929. Okay, next is you have to press amortization. Okay, the first thing what it is asking is set. Okay, and always remember you have to take the end. Then PM1, PM2. Okay, now PM1 means the starting month, PM2 means the end month. So what is the starting month and the end month? Okay, now we are doing a trial. Okay, so trial in the sense that what we will do is we will first find. Okay, again, as per the option, what is the lowest is 23. Okay, next is 47. So what we have to do is we have to find that uh, by the 23rd month, what is the loan outstanding? Okay, by the 23rd month, what is the loan outstanding? So what we have to do is PM1, I will enter 23rd, and PM2, this is my first try. PM2 also 23rd. Okay, and next you will find the rest of the things like N, okay, 240, then your I percent means rest of the things it will capture from the CMPD. So I'll copy this. It will even take the PMT, no need to calculate. You will get 3929. Okay, rest of the things you will find same like CMPD, and then the first part after the C by Y you will see the balance. So you have to find what the balance is. Okay, and simple, you have to press solve, and what balance amount you will see is 3483 654. 3483 654, and let me check here in the 23rd month. 3365. So somewhere I have missed. Okay, just a minute. Okay, sorry. I instead of 23, I put 3. Okay, and I'll go to the balance and solve. Yeah, 3365. So let me correct this. 3365,085. Okay, so what you are getting is the balance. This is the balance at the end of 23rd month. And now what you have to do is this is for the 23rd month. Okay, so this is we have done for the 23rd month. Same way, I'll do here. Same way, we'll see for 47th, the second trial. So no need to do anything. Just press escape. Okay, and in PM1, PM2, you write 47 and 47. Okay, and again you go to the balance and solve it. And what I'm getting is 319,8077. So 319, sorry, 31 lakh 98,000. So let me see here. Yes, so I'm getting that. So 3198 and 77. Okay, so that way we have to do trial, and then we have to see I mean, if you are using the calculator, we have to even see what the future value of savings are in the respective months. If it matches or exceeds the balance, then that is the answer. We have to find this also. You know how to find that. Okay, so you have to find the future value of savings also. Okay, any question on this part? Let me know, please. Any question? So this way, I mean, I know in calculator it can be somewhat tedious, but this way you have to do it. I mean, on this trial and error basis, you have to find where your future value of saving should match or somewhat exceeds the balance outstanding. Starting month and the end month. Now, since we have to find the balance, so PM1 is the starting month, PM2 is the end month. Now we have to see the balance for 23rd month. So that's why PM1, PM2 is 23, 23. In the second trial, it is 47, 47. Fine. So what I'll do is I'll stop for today, and the remaining two questions we'll see maybe in the next session. Mm-hmm. Mm-hmm. हाँ, अलग अलग निकालना पड़ेगा। वो फिर हाँ फिर वो हो जाएगा। हाँ हाँ, दैट बिकम फ्यूचर वैल्यू ऑफ एन्युटी। Okay, so I'll just put that become future value of annuity. So वो अगर recurring, if he is doing a recurring deposit, so future value of annuity, which is again your annuity multiply with 1 plus rate is to n per minus 1 divided by rate. It will be like this. Fine. So what I'll do is I'll stop for today. I have one meeting, and again at 10 we have another session for the last module. So I'll stop for today. We'll again, hopefully, we will continue tomorrow. Fine, fine. Thanks a lot. Good. Sorry? Sorry, sir?